I would like to talk about how high yield bonds or junk bonds can strengthen your investment portfolio. In other words, I'm considering the advantages of investing in high yield bonds. When we talk about high yield bond or junk bonds, they inherently come with these advantages, the benefits. Number one here is high returns. High yield bonds are known to offer significantly high interest rates compared to other investment grade bonds, providing investors with a potential for high return, a potential for a kind of enhanced returns. So, as the name implies, high yield. So it tends to yield a relatively higher level of returns compared to other investment grade bonds out there. Number two is diversification. Adding high yield bonds to a typical portfolio can improve diversification by introducing your exposure to different credit qualities and industries, potentially reducing your overall risk. Generally, you are exposed to industries, you are uh, exposed to institutions that provides or uh, that provide these bonds, and by so doing, you are kind of fully diversified across different uh, investment with different yield, with different related yield, related risk. Actually, different related yield risk, as well as different level of yield. So it serves as a very very good avenue for proper adequate diversification. Number three is capital appreciation potentials. If the issuing company improves, if it does very well, you discover that you stand to reap bountifully. If the company improves its financial position, the balance sheet is okay, the cash flow statement, the cash flow position is okay, and the income statement is all right. The company with a fortress balance sheet eventually will be able to give you the kind of returns you expect from this kind of uh, investment. Although generally speaking, stable, mature companies who are doing very, very well don't issue high yield. But really, in case you get into a company that is not doing well financially and they issue high yield bonds, if the company eventually improves, the company eventually like restructures or whatever, by whatever means gets a better gets into a better financial position, then you will stand to gain maximally from these kind of investments. Number three is steady income stream. There's despite the higher risk involved, despite the risky nature of investing in high yield bonds, you still stand to gain. It provides regular income, regular interest payments, making them attractive for income focused or income seeking investors. Number five is access to growing companies. Access to growing companies. High yield bonds are often issued by companies that are just coming in. They are new companies, they are growing companies, they are in emerging industries or those undergoing restructuring and are not actually that are bound to do fine, that are bound to grow in the future, and they offer investors opportunity for potential high growth, for potential high growth in the future. So usually you invest in these bonds with the expectation that the company will do well. All right, the company may not be performing well currently, and that's why the bond is coming at a high yield. That's why it's classified as junk bond. But all things being equal, if the company improves, I'm telling you, you will stand to gain. There's that high potential for capital gain in the future. Let's just hope that the company does well. Number 6 is inflation protection. High yield bond, because of the higher yield they provide, the higher interest or coupon they provide. You discover that whatever comes in is able to tackle inflation rates. The rate of interest coming in is more than what is obtainable. What is more than the inflation rate in the economy. So you still have that net, that's that buying power you could get from whatever comes in. Number 7 is broad market appeal. It's popular. High yield bonds appeal to both institutional as well as retail investors. Who are looking for returns that exceed those of traditional investment like stock market investment. So both I remember somebody like Michael Milken became very popular because of this kind of stocks, this kind of bonds rather. You see, so it's both institutional investors, individual investors can invest in high yield bonds. So it has that broader appeal. It's quite popular. Number 8 is recovery rate advantage. Recovery rate advantage. In case of default, high yield bondholders may still recover portion of their investment, typically more than equity holders. Equity holders are the actual backbone, the actual predominant risk holder, risk bearer of the company. So in the event of liquidation or whatever, the high yield bondholder, the junk bondholder will still get his money before whatever remains is shared to, if at all anything remains, is shared to equity holders. So they have that priority over equity holders, despite the fact that the instrument itself is relatively risky, but that priority is there. Number 9 is market inefficiencies. Active investors can exploit inefficiencies in the high yield bond market, uncovering opportunity for better than average returns. You could get better than average returns in high yield bond. The market is never efficient. It may be efficient in the long run, but in the short term basis, you could plug into inefficiencies here and there, particularly with investment in junk bond to be able to make an outsized returns. Number 10 is diversified issue base. High yield bonds are issued by companies across different sectors, different industries, and different geographies, enabling investors to target specific industries or regions to invest in. So it gives them that diversified, larger exposure. Different companies in different sectors, in different industries, in different regions. So you are fully and adequately diversified when you invest in a bucket or in a portfolio of high yield bonds. So please don't forget to subscribe and like this video. It will help me a lot.